Hey traders, this is Blake Morrow, and with me today I have Mr. Jim Welsh. And thank you, Jim. It's Friday. It's good to have you back. I know we missed last week, but
Right.
welcome back to the Trader Summit community because they all missed you. So
That's nice to hear, and thank you. And it's good to be back.
well, it's nice to have you back. And there's been nothing short of excitement over the last couple of
Yeah.
weeks since we last saw you at the Trader Summit event. We've seen the markets really rally, and the equity markets challenging, the S&P challenging 4,000. Inflation data has come through the market. We're starting to see other data that might be influencing the market, or maybe the Fed. What's your take on where we're currently at right now?
Okay. We talked a couple of weeks ago prior to the CPI, and my take was that it was likely to have a 7 handle just based on the mathematics of what was being taken off a year ago, add additional things. But the bigger picture, in my view, is that the Fed's, look at this analogy. The Fed's gone from basically 0 to 375 in the fund rates. So if you had a weights on your right foot, 375 pounds of weight, and the person who put that there said, hey, don't worry, I'm not going to put 75 pounds on. I'm only going to be doing 50 pounds. That to me is a good analogy of a pivot. A real pivot is I'm starting to take the weight off. And so that's the heaviness that the market hasn't, I think, fully accepted or acknowledged.
All right. Well, let's get into this first chart and talk about the NBER that you'd mentioned.
Yeah.
What are we looking at here, and why is this important?
Well, in August, you and I did, our weekly talks, and I kept kind of harping on the economy's not in a recession, even though there were 2 quarters consecutive of negative GDP report, negative growth. So, this is a tweet that I sent out on August 4th, kind of encapsulated our conversations. And I said, if you look at a broader spectrum of economic data points beyond GDP, you can see the economy is not in a recession. And the main point I continued to make was, to the extent that this is true, and I believed it so, that the Fed would be guiding Fed policy. And back then, remember, the market rallied really hard on the idea that, we're in a recession. The Fed's not going to have to raise rates as aggressively, and they're going to be bringing them down sooner. And to me, that was wrong. And that's why, kind of beat it into the ground a little bit, but I thought it was really important in terms of, what it meant for monetary policy.
Okay. And so what does this GDP mean, and why should we be focused on the Atlanta Fed GDP here?
Well, they come out with timely, we get the GDP report every quarter, then we get 3 reports actually. The first estimate, the second estimate, and then obviously the final. The GDP now takes current economic data. So it took retail sales that came out this week that weren't too bad, and it's estimating that GDP is at 4.2% in the 4th quarter. My only point is, whether it's 4.2, 3.2, that's not recessionary. And we already got a read on the 3rd quarter of 2.6 growth. So my only point to bring this up is my analysis back in August that the economy wasn't in a recession and that would shape monetary policy. I think we've seen proof of that in the reports that we've seen, both for the 3rd quarter and this running estimate for the 4th quarter. It's going to continue to shape monetary policy, which means the Fed is going to continue to raise rates, albeit the next one is going to probably be 50 basis points.
All right. And you brought up this chart of lending standards. Now, why is this important? Because, I mean, where do we stand as far as lending standards go?
Okay. It's important because very few people pay attention to it. Number 2, it really requires some understanding. If the Fed is the spigot in terms of liquidity flowing into the economy, what the Fed has done is raised the price of money, but they haven't really restricted the availability. So what bank lending standards, as they get raised, what that means is somebody a month ago would go in for a loan and get approved. But after the banks raise their lending standards, that same person goes in and it's like, no, we're not going to give you that loan, or we're going to give you the loan, but at wider terms. So a month ago, you would have been paying 2% above prime. Now you're going to be paying 3% to get the. So the point being is that tighter lending standards is like the banks are the nozzle at the end of that liquidity hose. And they've been tightening now the amount of liquidity they're flowing into the economy. So this represents another tightening of monetary policy. And you can see back in 2007, back in April of 2007, I thought the economy was headed for a recession and that we were going to have housing prices drop by more than 20%. And one of the things that really tipped me off was the big increase that you saw in March, the first quarter of 2007, of lending standards. So to me, this is a big deal because it increases the likelihood that we're going to go into a recession by the time we get into the middle of next year.
Okay, well, and your focus here is on profits. Now, I noticed, being obviously a chart technician, you got the two lines to the furthest to the right are pointing down. So what does this suggest?
Okay, basically the beige line is the lending standards, and obviously they're negative. And what we can see is S&P earnings follow lending standards. It makes sense because lending standards are tightened as the economy enters a slowdown phase and then maybe ultimately a recession. So they're like, hand in a glove. Lending standards are going up in anticipation of slower growth, banks trying to protect the quality of their loan portfolio. And guess what? It then has an impact on S&P earnings. Why? Not only just because of lending standards, but because the economy is slowing down and potentially going into a recession. So again, I don't think most equity investors, realize the domino effect that's developing here, especially when you think about, again, 44% of S&P volume is related to options that expire in 24 hours. Do you think any of those folks have a clue about this stuff? Do they care? No. But ultimately, it's going to make a big difference.
So that means you do think that the S&P is going to new all-time highs here in this next month. I'm joking, but we're going to go into that chart next. But before I go into this chart, I want to say, if you guys and gals like the information that Jim Welsh from Macro Tides is giving you, make sure you give him a thumbs up, subscribe to the channel down below so you don't miss this exclusive content we do every week. And also make sure you check out macrotides.com and our sponsor, Eightcap. Make sure you check them out as well. So let's go into your chart of the S&P. So here we are. I mean, we're grinding higher this week, and I think we held some pretty key support today, this week at 3,900 on this dip.
Yep.
So are we indeed heading to new all-time highs here?
No.
Okay.
No, I don't believe so. Again, as you know, what I try to do is marry fundamental analysis with technical analysis.
Yeah.
So things were really oversold in mid-October. My expectation was that we were going to see a rally towards 4,050 to 4,100, 4,150, pardon me. I looked when we got above 3,900, it's like, okay, take some money off the table. I think we're going to have a pullback. And then I kept pounding the table. The CPI is very likely to have a 7 handle. And what do you think the market's going to do? It's going to overreact, which is exactly what happened when the CPI came out on November 10th. Last Monday on November 14th, I basically said if the S&P trades above 4,009, lighten up. Because we're at a point where, geez, this can kind of go either way. A lot of the momentum indicators I use, Blake, were kind of topping and rolling over at overbought levels. So to me, it implies that one way or the other, I think the S&P is going to go down and test that green line. And that test is really the key point. It's possible. Again, people are talking themselves into thinking that, a 50 basis point hike means it's a pivot. It isn't. But as long as they believe it, they can still continue to bid the market higher. So ultimately, I think, the rally may be over. I think there's a little bit more upside coming. But I think as we get into the first quarter of next year, if I'm right about the economy, the Fed's still talking tough, I think we're going to go down and test the lows at near 3,500 and potentially down to 3,200. So I was just looking for a rally within the context of a bear market. We've gotten it, and now it's a question of is it over yet? That's why I was uncertain. I thought it made sense to take money off the table above 4,009.
All right. Well, it's good that you have, but let's see if we challenge that lower trend line, because we're going to just will this market higher, Jim. And how do you feel about the dollar? Because the dollar obviously has come down pretty aggressively.
Right.
What are your thoughts here?
Hey, for weeks we talked about the dollar as like, okay, we need it to drop below 109.20. That'll confirm a top. And of course, then the CPI report, it got smashed. again, positioning in the dollar was, very, very long. And that report just caused, I think, a big unwind. My expectation is once the top took place and took hold, a drop to 104.50 to 105 was likely. We haven't gotten there yet. When I look at the pattern from that number 3, you can kind of go 1, 2, 1, 2. The big slam down is wave 3. I think we're in the middle of a 4-5-4-5, because if you had a 1-2-1-2, you got to do 2-4-5-4-5s. So I think we're going to see real choppiness, but ultimately, the dollar, I think, is going to push a little bit lower. Can it ultimately get down to that lower trend line down, which I think is what, 102-ish? Yeah, that's a possibility too. But again, the Fed is going to continue, I think, to, again, downshifting is not a pivot. And they're going to continue to push rates and I think talk tough. Whether that means the top is in for the dollar, I think the jury's still out. I still think there's a chance that we could see another rally in the dollar index that takes it to a higher high. But in the near term, I think we're in a choppy corrective period with the dollar working its way lower.
Well, one of the beneficiaries of that weaker dollar has been a stronger gold. So gold finally showed us a little bit of a bounce here. Yeah, finally. I mean, whoops, let me go ahead and minimize that a little bit. So what do you think? What do you think here with gold?
Well, for a number of weeks when gold was bouncing around, below 1650, my take was, hey, I still think we're going to get a rally above the 1728. In other words, from that little wave 5 number, and then there's a rally from 1616 to 1728 up to wave A. The pullback I thought was a B wave. We were going to get a C wave that would take gold up to 1750, 1780. And then this past Monday, I showed this chart, in fact, that trend line going back, I think, a year and a half or so. There's 7 touch points. So the more touch points make it more significant. Yeah. So my belief was, hey, it's time to take some money off of gold. The expectation was it would rally to this price area. It has, and there's still the potential that gold could drop to a lower low below 1600 before I think a new bull market has begun. So Can it push a little bit higher? Yeah, but I just thought, my thought was be long, gets up to 1750, 1780, take some money off the table. And so to me right now, I'm kind of like waiting on the sidelines, Blake. We'll see what happens with this trend line. Gold is short-term overbought. We'll see how it unwinds.
Well, TLT finally started rallying a little bit, and we're coming off those lows. You've been expecting it for a while, and we've got it. So what do you do? I mean, if you're long bonds, you're short yields, what are you doing up here?
Well, near term, obviously, it's made a pretty good move in a very short period of time. Yep. I still think that, again, when I was recommending TLT, it was based on the idea that by the time we got to the first quarter, the Fed would have downshift rate hikes from 75 to 50, more evidence of inflation coming down, and that the economy would show more slowing. All of those things are constructive. So I still think TLT can pull back in the near term. My expectation, though, is that a move up towards 102 to 104 is likely, and there's still wave 4 of lesser degrees at 120. So to me, could we see 108, 110 in the first quarter? Yes, that is my minimum expectation. So finally, the bond market got news that it could finally respond to. It's interesting, Blake, yesterday, Bullard from St. Louis came out, talked about, geez, Fed funds could go anywhere from 5 to 7%. That's like, are you kidding me? That ain't going to happen. All right. But to me, both equities and the bond market took that prospect really pretty good. And again, I think we're going to get more signs of economic slowing. I think it's just an attempt by the FOMC to just keep reminding people. They don't, here's one thing I wrote about in last Monday's report. That big move up on November 10th, with stocks up, bonds rallying, the dollar down. Those are all components of financial conditions. Goldman Sachs said that decline that movement on November 10th was like a 50 basis point easing of financial conditions. So that makes the Fed's job a little bit harder. So I think that's in part why we're seeing this verbal pushback. They don't want to see financial conditions ease too much until they finally get to that restrictive level, and then let the increase in rates do its dampening effect on economic activity throughout 20.
And I mean, they've told us multiple times. I mean, CPI, yes, it was a little weaker, but we really got to see multiple prints, right? And so, so it's going to be interesting watching how the market responds over the course of the next few weeks, especially as we head into the Christmas and holiday season. But Jim, I want to thank you for being with us every week, holding our hands here at the Trader Summit community. How do I find out more about what you do?
Macrotides.com, or send an email to Jim Welsh Macro, and I'll send you the most recent weekly technical review so you can kind of get a better idea of what the information and the intersection between economic, monetary, and technical analysis.
Well, that's a great tagline, Jim. I'm glad you came up with that one right now. So thanks for joining us, and we'll see you next week.
Have a great weekend, Blake. Thank you.
You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.